Hello, everyone. Thank you for joining us today. My name is Andrew Paolillo, and I'm the Director of Member Strategies and Solutions here at the bank. And today we'll be discussing our latest insurance company strategy case study, funding CLOs with floating rate advances. So what we're going to talk about today is take a look at a asset class that has been growing in popularity with insurance companies, collateralized loan obligations or CLOs, and also a strategy that has similarly been increasing in popularity, that is entering into a spread lending transaction by buying the asset and funding it with advances from the Federal Home Loan Bank of Boston. So from a 30,000 foot level, what is a CLO? It is a structured security that is put together as a floating rate instrument, and the index used in those securities is 3-month LIBOR. Now, as many of you are well aware, there is a global connected LIBOR transition ongoing, where that index will be going away and other indices are coming into the mix to take their place. At present, CLOs are continuing to be issued, still indexed to LIBOR, but with robust fallback language in place, such that if LIBOR is no longer published ahead of the 2023 termination date, that there are rules in place for what the asset will ultimately float off of. In terms of the cash flow profile of the principal, the securities are prepayable, and there are call and reinvestment periods that govern how fast or slow cash flow may come back to the investor. And accordingly with that, the average life of the security will vary depending on those things we just talked about, also where in the capital structure you are in terms of seniority. Looking at the funding side of things, there are two particular advances that stand out from our product lineup that are natural ways to fund CLOs. So those would be our two floating rate advances, the Sulfur indexed advance and the discount note auction floater advance. And we'll go in a slide or two into greater detail. But you can see here the similarities and some of the differences with what's happening on the asset side. That these advances are both floating rates. They have different indices versus LIBOR on the asset side. And we'll get into a little bit more what exactly is SOFR, the secured overnight financing rate, as well as a deeper description of what discount notes are. In terms of the prepayability of the advance, both advances can be prepaid. The SOFR index advance is subject to a prepayment fee. The discount note auction floater, or the DNA floater, is interesting, is that there is no fee at each reset date if the member elects to prepay. And in terms of the maturities of the advances, they're highly customizable, and you're able to select maturities in the case of the SOFR floater anywhere as short as 1 month all the way out to 20 years, where the DNA floater has maturities ranging from 1 to 20 years. So before we jump into looking at some examples and actual funding strategies, let's take a little bit deeper dive into what some of these indices are that construct the index for the floating rate advances. So first, let's look at the secured overnight financing rate, or SOFR. So what SOFR is, it is a index that is based off of transactions that are occurring in the huge repo market. So the key characteristics here are that they are transparent, as they reflect actual transactions occurring in the market, and they are reflective of overnight transactions that are fully collateralized by U.S. Treasury securities. So really no credit risk involved in those borrowing transactions. So very close to approximating a risk-free overnight rate. And important to note here, as we mentioned earlier, the LIBOR transition is well underway, and the SOFR rate has been endorsed by the ARC, the Alternative Reference Rate Committee. So that is a group of private and public market participants who have been tasked with helping the very complicated and with many moving piece transition of the cash and derivatives markets moving away from LIBOR to find a new solution, and ARC has been endorsed as the official preferred replacement for many LIBOR instruments. Switching to discount notes. So discount notes are effectively the cost of funds for the FHL bank system. So think of it as Federal Home Loan Bank T-bills, if you will. So auctions are held every Tuesday and Thursday at some key tenors. So maturities of 4 weeks, 8 weeks, 13 weeks, and 26, where the Home Loan Bank system offers up to broker-dealers and investors funding at those terms. So in terms of the DNA floater, members are able to use either the 4-week or the 13-week, or the 1 month or the 3 month, similar to LIBOR. And members can select either of those terms to be the variable rate index in the floating rate advance. So as we'll see in a little bit, using the DNA floater and that 13-week maturity to align with instruments, assets that typically benchmark off of 3-month LIBOR can lead to some pretty tight correlation. So we mentioned correlation. So what we're looking at here is a look at the relevant short-term indices going all the way back to 2015 and seeing what those rates are and where they've been and what the correlation has been. So certainly this is of importance as we're thinking about what happens when there's an asset with one index and it's being funded by advances that are benchmarked to other indices. So there's going to be an element of basis risk involved in that transaction. But as we can see here, the correlation between the indexes in question here are extremely tight. So when we look at the path of 3-month LIBOR and the 13-week discount note, we can see that they've tracked extremely tightly over the years. In fact, the correlation of 0.982 is extremely high. And one thing to point out here, we talked about how DNs are essentially the cost of funds for the home loan bank system, almost like T-bills. Well, you can see that just eyeballing the green and the dark gray lines, we can see that they moved in a very similar direction through 15 and 18 as short-term rates began to rise. But we also see the spike in LIBOR in certain periods where that gap moved a little bit wider. And that's because of the credit component that is built into LIBOR, such that for anybody doing this type of transaction during those periods, that was quite the favorable move, because you had your asset, which was exposed to that credit component, seeing the index or the amount of income that you were to receive go higher, whereas the funding index was much more stable and lower and resulted in a lower amount of interest expense. The blue line here is the 90-day Sulfur average. And there's a couple things to point out here, is that one, in order to make this an apples-to-apples discussion, we had to take Sulfur, which is an overnight rate, and look at what the accumulated average would be over a 90-day period in order to make it truly comparable to 3-month LIBOR. And then the other thing to note here is that that line only starts in 2018, as that is when Sulfur began to be officially published. And like with LIBOR and DNs, the correlation between 90-day Sulfur and 3-month LIBOR is extremely strong as well at 0.976. We won't spend too much time on some of the particulars of the asset side, but just to give some context on the amount of spread available in some of the CLO tranches, but also looking at the capital structure. So on the left-hand side of here, we've tracked the spread levels on new issue CLOs for the month of July 2021. and we're looking at two different classes. We're looking at the most senior classes, the AAA rated tranches, and we're also looking a few ticks down on the capital structure at the A-rated classes, and that's those the dark blue lines up top and the AAA being the green below. So we can see that the spreads available for AAA rated classes have been between about 100 basis points and 130 basis points, depending on the specific deal. For the A-rated tranches, there has been a wider band which those classes have priced, ranging between 195 basis points all the way up to about 260 basis points. So in this environment where there's a lot of excess liquidity in the market and credit spreads of all stripes have tightened pretty significantly, this is one area of the markets where there is a significant amount of spread in highly rated instruments are still available. And on the right-hand side, you can see the typical capital structure for a deal where the AAA tranche makes up a significant majority of the amount of the deal, in this case nearly 60%. And then going down the ladder, you see the smaller amounts in the softer credit ratings, culminating in the equity portion of the deal. So switching back over to the funding side, here's an example of some of the spread levels that are available on the two floating rate advance products that we had introduced earlier, the Sulfur index advance and the discount note auction floater advance. So here we have a spread curve, if you will, looking at the spreads for the two different products. And we can see, as mentioned earlier, where they differentiate the most is the fact that the Sulfur floater is available on shorter maturities inside of 1 year. So you can see the 3-month Sulfur floater priced at 20 basis points over Sulfur, the 6-month at 25 basis points, and also the 12-month at just 23 basis points over Sulfur. In contrast to that, we have the DNA floater, and we've used the 13-week or 3-month version of that, again, because that's going to align with the 3-month tenor of LIBOR, which is the index for the asset. And we can see here the spreads on those starting at the 12-month mark at 32 basis points. But then as we go out to 2, 3, 4, 5 years, we can see those spreads are pretty narrow at 40 to 43 basis points. And remember, that structure affords the ability to prepay with no fee the entire amount of the advance at every quarterly interval. So let's take a look at an example. So we're going to take some assumptions for the types of spreads that we might be able to capture when looking at the asset side of the equation. And then we'll look at two different paths that we can take on the funding side that are going to produce varying levels of spread, but also of average life, depending on whether it shortens or extends, because as we mentioned, the DNA floater does give us some of that flexibility. So first on the asset side, we looked at the spreads where recent deals have been coming, but just for simplicity and round number sake, we'll take an example where we take 75% of the pot and we invested in AAAs at a spread of plus 100, and we take the remaining 25% and we put those into the A-rated tranches at plus 200. And what that does is produce a blended spread of plus 125, and given the 3-month LIBOR at an index rate of 12 basis points, that equates to a day one yield of 137. On the funding side, strategy one will take the 5-year DNA floater to really extend the maturities of the floating, because we know the asset side is going to be a little bit further out the curve, but because of the uncertainty of potential paydowns, we do want that flexibility where we could return the funding early if there is some amortization. Strategy 2 takes a similar approach where we're going to use the DNA floater as the core portion of the funding, in this case 50% of the overall amount. But what we're going to do is, because as we saw on the previous slide, we saw that the pricing for the Sulfur index floater was extremely attractive with very narrow spreads, particularly at the 3 and 12-month marks. We want to take advantage of that to build a ladder, if you will, in order to really maximize the spread that we're able to capture, but still make sure that we have a sufficient amount of average life in there to make the mechanics of the spread lending transaction work. So when we take those assumptions and we see what spits out the other side, we want to take a look at what the average life of the funding looks like, and we also want to look at what the total cost of the funding looks like, given the two different approaches. So when we first look at the funding average lives, we can see for strategy 1, there's going to be the greatest variance between the shortest the average life can be as well as the longest. So it can be as short as a quarter of a year, and that's a function of being able to prepay the entire amount of the DNA floater at that first quarterly reset. Alternatively, if you were to leave the advance to maturity, then the average life would be 5 years. We take a look at strategy 2, and we can see a narrower band, right? The average life at its shortest is just inside of a half a year, and the longest average life is a little bit under 3 years. And now this may be more practical and realistic in terms of what the cash flow profile of the asset eventually looks like, because you don't necessarily need or expect to see principal paying down in that first part of the period where the asset is being owned. That only once it gets past the call and reinvestment dates is when the potential for the asset to pay down is. So that's what really creates the opportunity in leveraging the narrow spreads on the Sulfur index advance and creating that staggered ladder for a portion of the funding. And we can see that borne out when looking at the funding interest cost. We can see that strategy 10 produces a total interest cost on day 1 of 37 basis points, which is 10 basis points below that for strategy 1, which was the DNA floater exclusively. So certainly, being able to capture those savings has some appeal. And when you think about assets that are amortizing and have exposure to prepayments, then having that flexibility in the average life, creates some opportunity, to align those cash flows as well as produce some savings. And when, from a summary perspective, if we look at what that translates to in terms of the net spread produced, we can see that when we subtract the funding cost from the asset yield and boil it down to a spread, we can see that the spreads captured are between 90 and 100 basis points, where the interest rate risk, because we're putting a floating rate asset versus floating rate funding, is mitigated pretty extensively. So this brings us to the end of our case study. Hopefully you found some of this to be of value. And I would leave it with this to say that if you have any questions, please feel free to reach out to anyone on the strategies or the member funding desk or your relationship manager. We'd be happy to discuss in any level of detail some of these strategies or answer any questions on some of the various advanced products available to you. And I will point out that in the coming weeks and months, we'll be continuing a partner webinar series where we'll be bringing in outside parties, asset managers who deal heavily with insurance companies, and producing some webinars where we'll take a deeper dive into popular asset classes for insurance companies, such as CLOs, where they'll be able to hopefully provide some education and shed some light on an asset class and a strategy that continues to gain an awful lot of traction. Thank you very much, and have a great day.